All right, good morning, everybody. My name is John Oliver, and I am with ARC Benefit Solutions. And part of what I do here is actually starting into the life insurance. And so we wanted to start a webinar series of some different topics just to kind of get you aware of what's out there and just to see if we can't help. So I really appreciate you guys taking time today out of your busy schedule to be with us. So today is about life insurance, and it's just going to be kind of a basic understanding of life insurance and why people maybe stay away from it a little bit and why the importance of it. So a little bit of background on me. So I joined ARC just a little bit over a year ago. I was with some companies like Fidelity Investments and Ohio National Life Insurance Company, and I've been in some different roles in insurance and some investment type products for probably a little bit over 20 years. So part of my role here is I've got a Medicare book, and I'm going to do some life and disability and maybe some annuity products. We'll see on that one. And I do have a real small property and casualty book through another agency that I've had for a couple years now. So again, I just want to say thank you for joining us this morning. I don't know if I can make life insurance a ton of fun because it's not the greatest subject sometimes to talk about, but it is one that I really feel passionate about just because I feel like it needs to be part of our financial foundation, and it's preparing for those unexpected occurrences that we never dream about. And of course, life insurance is never about us. It's about protecting our loved ones. So and if you guys have any questions, feel free up in the in your webinar. There is a questions tab. Feel free to put those in, and we'll get to those towards the end of the webinar. If we also have an attachment as well that'll be here in the upper right with materials that you guys can download. We actually have a worksheet at the end that we'll do, and kind of just do a little mock run through for you guys and just see kind of where certain products may fit in certain situations and what might make sense. So that's the whole goal today, is to just try to get a little bit better understanding of life insurance and where you can go to get it, obviously, and what carriers are out there, and then obviously what product might fit best for you, because not everybody's the same. Obviously, and life changes, it revolves, and certain products meet certain needs at different stages of your life. So hopefully that will kind of help. And obviously, we'll do a follow-up webinar as well for you guys, and maybe we'll delve into a certain product and how it works. So this is just kind of life insurance 101, and then maybe we'll go to a 201, expand a little bit more on a product and really delve a little deeper into it if you guys would like to see it. And if there's a certain product you want to see out there that you've heard about, getting a lot of information on, I'll be more than happy to do my best to get that for you. If there's something I can't answer for you, or if there's something you want to do outside the webinar, I'll have my contact information up as you can see now. Feel free to email me, feel free to call me, and I will definitely get back to you and do my best to help you out, okay? So the agenda for today: what is life insurance? The other factor is the different types of life insurance. There's a lot out there. A lot of people are advertising and marketing, and we're going to try to figure out how they work, right? Just the basis. We won't get real deep into them. Some of it gets a little much and a little overwhelming at times, and so no need for that for today's webinar. We'll definitely touch on why people buy life insurance, the importance of it. The other point would be why people put it off, believe it or not, and a lot of factors there as well. And then lastly, we'll just kind of go through an example. I was going to have Trina on with us today, who works with us, and a very, very experienced agent here at ARC Benefit Solutions. Unfortunately, she's under the weather, so no worries. But what we'll do is with that attachment is actually just kind of break that down and walk you through kind of the first part of a needs analysis and seeing how much insurance you need and potentially what type of product might fit that need as well. So, what is life insurance, right? So, pretty basic. It's a policy that's purchased through an insurance company to protect the people that are most important to you, the ones that you love the most. So, even though the insurance is on you, ultimately the goal is to pass that legacy piece off and take care of your loved ones. It's so important right now, especially in these inflationary times and how so many things have gotten so expensive. There's a stat out there right now, believe it or not, that 101 million people with life insurance are currently underinsured, right? And so, obviously they took that first step. They realized the importance of it, which is great. So that's the first step, just getting some insurance, because you can always try to get it later as long as you're healthy. But now it's, let's look at those policies. Let's look at your situation, maybe delve into it a little bit and try to figure out if you've got enough insurance for where you sit today and maybe what that future picture looks like. And that's where we come into play. Obviously, there's a myriad of avenues to go, but obviously, this would be a wonderful opportunity for ARC Benefit Solutions to try to assist you here as well. Um, why is life insurance so important? So, a lot here with this piece. What I had mentioned previously, it's actually not for you, but for the people you care the most about. It's the ability to cover those major expenses. So, majority of folks have mortgages and credit card debt and personal debt. You've got car loans. If you have kids, there's student loans. Even if you don't have kids, there's probably student loans. Believe me, I'm getting ready to wrap up with my kids, and it'll be a breath of fresh air to get this finally done. But as you know, it is so expensive out there, and it truly, it really takes a village of people to try to get you through for your kids and even for yourself to fulfill those dreams that you're trying to accomplish as you navigate life. And then lastly, just funeral expense, right? Just burial cost. And we'll talk about that towards the end of the webinar. We have a really nice piece. It's really kind of walks you through just getting you thinking about certain things on your coverage and how to cover it, right? And how much you might need. But obviously, there's funeral cost, right? Rather it's even cremation, you still have some cost associated with that, and then you've got the traditional burial and trying to cover that as well. Um, with life insurance, I can tell you it gives you that peace of mind, right? To know that those essential items, as you have passed on, right? That that your family can stay in that home that they're in, right? Um, you've got dreams for your kids, whatever those dreams are, right? Life insurance gives you that ability to keep those dreams alive, right? And I know it can kind of sound a little far-fetched at times, but in reality, life insurance does give you that ability, depending on the amount of money that is being passed through to those beneficiaries. You can fulfill that legacy piece, and it truly is. And it's a wonderful thing to be able to do, to know that once you left this earth, your loved ones then are not reeling, trying to figure out what the heck we're going to try to do. Am I going to have to go back to work if I'm a stay-at-home wife, right? All of those things, a mother with kids and scrambling to try to figure out how are we going to cover this. And that's the last thing you want to go through when there's been an unexpected passing. It prepares you for the unknown, obviously, allows you to prepare when that worst has happened. The last thing you want is to worry about money. It's just awful, right? And there's been families, I've had friends, trust me, that have gone through it. And, there is GoFundMe. I get that, and that's wonderful. And people come out and they love to help, and I think it's wonderful. But at the same time, if you can avoid that and put a policy in place, I think you'll be pleasantly surprised. It's not nearly as expensive as some people may think. In some respects, it can be, depending on health and all of that, but we'll get into that later. But in all honesty, right now, those policies have become very affordable. And it's a great way just to make sure that your loved ones are squared away. And the other thing, it's a great question to ask, and my family included. Would we struggle financially if a loved one passes away? And I can tell you truthfully, it takes two incomes for me and my wife to keep the doors open, right? And I'm being very serious there. And I can tell you, if we did not have life insurance, either on me or for my wife, it really would impact us. So we really take this really important, have them in place, and really believe in the power of life insurance and just making sure it's covered, especially in those liability years as the kids are young, the mortgages, the school debt, you name it, right? You may have parents that have moved in with you that you're caring for. There's a myriad of expenses that come up, and you really have to plan for what that's going to look like. And that's why a life insurance plan makes a ton of sense, right? So we see a financial planner for all your financial stuff, which is great, but life insurance should be a foundational piece of that puzzle for you. Types of life insurance that are out there, right? There's a bunch. They've evolved a little bit over time, obviously. They've changed. They have certain names associated with them, but ultimately they may come down to one product, which is different options, different shoots off of that type of product. So it gets really confusing. And there's a lot of working pieces in certain plans, right? And it keeps people guessing and they're not sure what to do, so they kind of put it off in that respect. But let's talk about the different types of insurance, right? So the first one we're going to touch on is term insurance, okay? Now, term insurance, in a simple way, is just pure protection. You have a policy in place, whatever that death benefit amount is, but it's really truly for a period of time. And that period of time can be 10 years, 15, 20, 25. I even have carriers that'll go 40 years out on a term policy, right? And so there's no cash value buildup. So sometimes people are like, oh gosh, term, I just feel like I'm throwing my money away. I'm not going to use it. And I'll touch on that, right? Because there's no buildup of cash. Now, the new insurance that's out there on term, and I'll talk about it in a follow-up webinar, but they actually have something called living benefits, and I'm just going to touch on it for a second, that are attached to a term policy that if you get critically, chronically, or terminally ill, you can tap the death benefit, which is fantastic, right? So in those times where those expenses are extremely high, and especially in a terminal situation, you may need that life insurance, right? So you're going to borrow against that death benefit. If you want to go on a trip, go on a trip, right? You've got 12 months to live, go live, right? I'm a firm believer. Just go have fun in that balance of time, right? If you're disabled, right, you can tap into it, a portion of that death benefit. Now you're borrowing against it, so that death benefit comes down, but that is kind of a new feature that we've seen for the last few years that people are tapping into. It's a great way. So instead of having a disability policy on the side, which I'd still highly recommend, but if you don't and you need to tap into a death benefit to pay bills, I get it, right? Now, term insurance, I have it, is when you're young. Now, that is true. That is a true piece. That's not always the case, right? It could be for someone my age where I sit today. I have term policies myself. If I still were going to get some additional insurance, I may still look at a term just to get us another 10 years, right? Maybe. We'll see. But typically, it's really nice to look at when you're younger. One, the premiums are cheaper. You're younger, it's based off your age. Typically, you're healthier, right? You have larger liabilities. You've got school debt. You may have just got married. You've taken on that school debt as well. You're trying to buy your first home. More than likely, you've got car payments. This is the American way. We've all got it, right? Credit card debt, personal loans, whatever it is, right? At those younger stages, you need a policy, whether it's $500,000 to $1 million and plus, whatever it is, right, to cover those liabilities, because you have to cover the income for that other person as well, potentially, right? And yourself. So it's a great way to get a policy that's much cheaper, much, least inexpensive for you method to go and give you that peace of mind that we talked about earlier. So it's a great way to get a lot of coverage for much, much less cost. The next type of insurance, from a life insurance standpoint out there is your permanent insurance. Now, there's a lot of different permanent insurance out there, but in this piece that we're looking at right now, guys, this one is just a base whole life policy. It could be a 10-pay life where you just pay the premiums for 10 years and the policy's paid up for life. There's a 20 pay life, or it may be a whole life policy that's being paid for the rest of your life. A lot of them mature at age 100. Some now go to age 121. So little variation, just depends on the premiums. But the nice thing about whole life is once you have been able to pass that insurability test and the policies in place, as long as you continue to pay those premiums, you have a policy for life, which is great. With term insurance, that term, to go back on that piece real quick, is it could term out on you. So if you do a 10-year term policy or a 20-year, whatever it is, at the end of that period, some companies, that policy is over, right? And that's why a lot of people sometimes say, oh gosh, I'm wasting my money. I'm healthy. I'm in good shape, right? I'm just wasting my money because I'll still be here 20 years from now and I put all that money out and it didn't really get to use the policy. I understand that. Now, some policies will allow you to do an annual renewable term. All that means is if you have a 20-year term policy, the next year, it's now based off of your age, where you sit at that point in time. So if you were 25 and you had a 20-year term, at age 45 now, that term policy for that amount of coverage is based off your age at 45. And every year thereafter, that policy is going up based off of your age. So it gets really expensive. So a lot of times then we'll just turn around and maybe look at a different type policy because they may not need that type of coverage. It's been 20 years. Some of those debts now have extinguished, and now they're able to get a smaller policy, cheaper amount, but still want some coverage just in case, if that makes sense. So that's the reason people look at whole life insurance. Now, it gets a little bit more expensive, and you don't nearly get the kind of coverage that you would with a term policy, especially with that kind of premium, right? But some of the nice features of a whole life policy or permanent policy out there, it builds cash value. It grows at a fixed interest rate. So a lot of your whole life policies, some of the minimum interest rates could be at 1.5%. It's nothing to write home about, but you are at least getting something built up. And the money that you're putting in is going towards that cash value, which is really nice. So there, not to get too into the weeds here, but there's a cost of insurance that goes up accordingly. But as you're putting that premium in, you're starting to build cash value. And it usually starts around year 2 or 3, depending on the carrier that you go with. A mutual company um, has what they call participating dividends. So some of those dividends that they pay out annually to you, you then can either take them as cash or you can buy additional death benefit. So it's a great way to get additional coverage without having to show insurability. So another nice feature for whole life insurance. As that cash builds up, um, you have the ability to take loans. Now, with loans, though, keep in mind it is going against your death benefit. So, as an example, if you have a whole life policy, and I'm just going to throw out $50,000 as an example, and you need to borrow a couple $1,000s, well, now your death benefit, if you were to pass, would be at $48,000 less any interest that accrued on that loan. Now you can pay that loan back over time and then get that debt done on the policy, and then that puts your whole life policy in that example back to 50,000, if that makes sense. You also can then take that cash value if you choose. So if you want to go buy a car and you've got some nice build up, you can take a withdrawal against that cash value if you choose. Again, you're taking a loan in that example. Another option is just take the cash value. So if the whole life policy got you through that period of time that you truly needed that coverage to be in place, and now you no longer need that kind of coverage and you want to take the cash, you can cash in the policy and get a check from the carrier for that amount, whatever it is. Now, will that be taxable? Potentially, depending on the cost basis in that policy, meaning the premiums that went in, there is kind of a cost basis associated, and any gain then would be a taxable back to you. Um, so another really nice feature in a whole life policy is, and I just had this probably, oh gosh, a couple months ago with a client that I am actually still working with. But they have a whole life policy. And at this point, it's gotten really, at this point, it's expensive. And they really, for the amount of coverage they have, um, it really didn't make fiscal sense for them to keep it. So they opted then to stop paying premium and took whatever that cash value was and did a paid up policy with that cash value, which was a great way. So we secured them with kind of some burial insurance. And then I'll explain that with the final expense piece. And then we turned around and did a term policy essentially to give the grandkids money. And that was a great way. And we saved them money on a monthly basis. And we're still working on the policy, still trying to get her approved, but a neat little way. As you guys can see, there's multiple options. And we can look at that for you, which is really nice. So ARC Benefit Solutions has partnered with a general agent, which is part of my upline, and they have been wonderful to work with and just fantastic. And so when I can make a call and we can work out some ideas and we work together and really try to help people figure out this puzzle, because ultimately at the end of the day, we're all in the same boat together, and me included, trying to figure out how to get through this world we call life, right? And trying to do it the best way we can. So and then the nice thing is with a whole life policy is as long as you continue to pay those premiums, or if you do get into a situation where you have to borrow and use premiums to pay or use the cash to pay your premium to keep that death benefit in place, you have that there, which is an awesome feature. So again, whole life insurance has a lot of nice little benefits, but it does get expensive, and it's definitely much more costlier than a term policy that we just looked at. The next type of life insurance, and again, this one's called universal life. And on this one, just so you know, this is kind of an offshoot of a whole life policy because it is permanent insurance. It does build cash value. So very synonymous, in that respect with a whole life policy, right? The difference on this type of policy is that it's based off of a market interest rate. So, not to get really confusing, we saw these policies way back in the day, and we're starting to see them creep in to the marketplace. And the reason I share that with you is because going back probably a good 25, 30, maybe 35 years ago, we've got products out there that we're touting that if you put in this money with that interest rate, you're essentially going to allow this policy to carry you through and have a death benefit and not really worry about having to pay premiums for the rest of your life. Okay. Well, we're starting to find out, as you've seen in these interest rate environments that we've come across, and now we're starting to creep up a little bit now. But those policies, unfortunately, were not able to sustain what they originally thought they could do. And so people today now are having to come up with more and more premium just to keep the death benefit afloat. Okay. The other drawback on this type of policy, not that it's bad, but I do want to give just one drawback, is they do have a surrender charge to them. And it can be lengthy. It can be 10, 15 years out on some of these products. So this is not for the short-term person. This is for someone that's thinking long-term. And as you know, life changes, your situations change all the time. And so you really have to think through, is this going to be the right policy for me? And if it's not, then we do a pivot and maybe make an adjustment if we can, if you're able to get insurance, right? And the big piece is, are you healthy enough? Are you insurable enough to be able to get what you need, right? The one pro to this, though, I mean, there's several, is that it touted that you had flexible premiums. So is life adjusted, and maybe you didn't have the amount that you need to pay that premium monthly, the policy then could kind of take care of itself. And it worked for quite a while. It just then adjusted, and all of a sudden now people are having to come up with X amount of money, or they're figuring out they don't have the money in that policy, and that policy is getting ready to expire, and that gets really nerve-wracking. And so the nice thing about this type of policy, and why I showed it, is it can be less expensive than a base whole life policy, and why it came to the marketplace. So just one to kind of food for thought to think about out there. Next would be a variable universal life. And so again, it's a permanent policy, much like whole life, right? Because of that permanent piece in place, you have a death benefit that's in place. The difference is it has now got an investment account associated with it. So if you want to be able to, invest in the market, you can invest in mutual funds and bonds or whatever your choice is that you feel is necessary. And it's a great way to accelerate your cash value and ultimately increase the amount that you have in that policy. You also take on a lot of risk in those down markets. So you have to be really careful on this type of policy as well. So when the things are good, it's great. When they're not, it adjusts accordingly. But again, everybody's situation's different. Everybody's appetite for certain things are different. People are willing to take on more risk, others aren't. People just want peace of mind. And if that's what you want, maybe this product really might not be for you, but it does have a lot of flexibility. Again, it does have a surrender charge, so it's more of a long-term picture because with that surrender charge, if you do have a set amount of cash value, and let's say it's a 15-year surrender charge and you're in year 10, you've got 5 years you haven't fully completed. And so you're going to lose a little bit of your cash value. So some negativity on that, not to, say that's a huge con, but it is, no one likes to lose money. So one, you want to be a little careful with on that. And then lastly, and this one's getting a lot of probably airtime. You're probably, depending on where you're at in age, you're seeing a lot of commercials. You may be getting stuff in the mail on final expense. And I do get people to ask me, what is final expense, right? So honestly, it's just a funeral or burial policy is really at the end, it's your final, right? And so you've gone through life. You've probably had a term policy, and it got you to that point that got you out of all of those longevity or liability years, right? And it took a while to get out of that, the college, the mortgage, the debt, or whatever that picture looks like, right? Now you're at a point of retirement, you're getting ready to leave your employer, and you may have had employer coverage as well. And so that employer coverage more than likely may not follow. If it were to follow with certain companies, it gets really expensive and it's not worth it, right? So a lot of people then will just drop that policy, but they also want a policy in place to cover their burial expense. Now, some people may have it in their checking or their savings or whatever investment account, and they may not need life insurance. But for others, they don't want that to have to tap into it. To them, that premium that they're paying makes sense to have that death benefit. So final expense could make great sense. It's typically for someone 40 to 85. And in reality, it's really someone probably 60 to 85. I do have one carrier that'll go to 90, believe it or not, which is amazing. But theoretically, it's really just for burial expense. We see policies anywhere from 10 to 30,000. You can go up to 50 if you choose. Just depends on price and if it's worth it. But a lot of times it's really just trying to cover, the burials, to kind of give you an idea. So, excuse me, those were the different types of life insurance that's out there. Now, obviously, there's different options and offshoots, and a really good product out there called Index Universal Life that I actually kept off this webinar for now, and we'll probably show it in a future webinar. There's a really neat feature and some really neat options on that type of one that I think I'll do for a future webinar on there to kind of show you. So um, the next screen is when is the right time to purchase life insurance? And I kind of chuckle at this when putting this together, and then when this got put in to our webinar. It's a loaded question. I mean, extremely loaded, as you guys know. When you're selling, every time's the right time, and that's part of the chuckle. But in reality, um, it really just depends when you have a life event that kind of gets you to thinking about life insurance. And as you progress through your life, it changes, right? Your needs change and your exposures change, and who you're trying to cover as your family grows potentially. And then all of a sudden, the kids come. And if we're lucky enough, the great grandkids come, right? And it's that again, and I don't mean to just keep belaboring this, but it's that legacy piece, right? What can we do when we leave this earth to leave it better and put the folks we love the most in a much better position, or at least give them a wonderful start to life and help them through life, right? And so, but I do like that to kind of just ponder a little bit and think about on there. And it really gets you to kind of think about where you're sitting today and maybe what your situation looks like as well. Um, the next screen here for you guys is the reasons people buy life insurance. Um, there's probably more, but I just kind of wanted to touch on the first four here, as you can see from the screen. The first one is simply pure protection. And when we touched on the term insurance policy, I really see where that fits into play, right? For just pure protection. You just want some coverage. You want it for a period of time. You want it to cover those necessary essentials. Um, and that one makes great sense. Another reason people really look at life insurance is for income replacement. So, obviously, I'm married with my wife, and we would definitely want to try to replace her income, and vice versa for me for her. And so that's another reason to really look at life insurance, because You can save all you want, but you never know when that unexpected event is. So you may have a fantastic plan in place and put X amount of money away a month, but you may only be 2 months into that plan and that unexpected event happens. You can't replace that income, but life insurance can. It's got a really powerful way to be able to handle that for you immediately once that policy is put into place and those premiums are being paid. Another really nice benefit is it's a tax-free benefit, um, which is enormous, right? So lump sum money handed over to your beneficiaries in a tax-free fashion. Huge, huge benefit there. And then as we looked at the whole life policies, right? The universal as well and the variable universal life and your final expense, all of them have some form of cash value growth that allows you to tap into, whether it's a loan, surrender, whatever it is, you have that ability to do so. Okay. Now, on this piece, and excuse me for 1 sec, I'm just going to get a quick sip here. I apologize for you guys. This one, I really think a lot about as you guys see it on your screen. Um, the reasons people put off buying life insurance, right? The first one, and we've all done it. I've done it, trust me. We're young and healthy, right? And I get it, right? You're coming out of college or you're coming out of high school, whatever it is. All you're thinking about is buying that first car, that first apartment, right? You can't wait to go out, buy dinners, whatever it is, right? The last thing you're thinking about is life insurance, right? One, it's not a subject you really want to talk about, nor do you really even think about. But when we talked about that one piece about when is the right time to buy, believe it or not, when you're young and healthy, it's a great way to get a ton of insurance in place for very, very little cost. And as long as you're willing to pay the premiums, right? And as you grow through your life and your income increases, those premiums really don't put a dent in really probably your budget. But it's a wonderful way to as kids are coming out of college or wherever, high school, get a policy in place on them. Get as much as you want, because if you think about the cost you put in versus what that death benefit is, in all honesty, it makes great sense to do that. So they have it through their employer, right? I get it. We all have probably for pennies coming out of your paycheck, you have some form of insurance, whether it's 1 or 2 times of your salary of a death benefit, right? And it's great. But the problem is we don't know when, if we're going to stay with that employer. A lot of people are jumping, trying to find a better solution for their life and, a ton of opportunity out there. Hopefully that company you leave will have the benefits to offer you. But remember, if something happens, that still may not be enough, right? Health wise, right? You have to think about your insurability. We all have health events that have happened through our life that, really question whether I can get insurance for the rest of my life. And the employer piece really is just a small amount. And a lot of times we don't even include it when we look at your needs analysis, meaning the amount of insurance you need to cover your liabilities. It's just an extra, it's a bonus. Because if it passes through your beneficiaries, that's fantastic. But in reality, we kind of act like it's not there in reality. We get a lot of people say, oh, it's too expensive. Well, in some respects, it can be. If someone's not as healthy, right, or they can't get the coverage they need, and it's expensive. I get it. But what we try to do then is figure out what can we cover, right? And if it's a mortgage and we can't cover all the mortgage, then maybe what we try to do is cover part of it for 4 to 6 months. So when the beneficiaries, right, in that estate are left with a home and maybe there's a mortgage left on it, it allows them to continue to pay those real estate taxes, pay that mortgage, right? Pay the fix ups, whatever it is, buy some time until they can get that house on the market and get that home sold, right? And so life insurance, you may not think about it, it's a great way to use it, right? So we use that more in the mortgage protection world, right? Especially if we can't get people the kind of coverage they need, we try to figure out how much can we cover them, at least get them a policy in place. Next, they won't qualify. That one's tough for me. It kills me because it's tough enough getting in front of people as an agent, right? And then finally you do, and you build this great rapport, and you'd love to have them as a client and build that relationship over time and get to know their families. That's part of why we're in this business. We're just in this business to help. And if we can help, we try to figure that out. But if they can't qualify exactly for what they need, I do have one carrier, actually have two, that will qualify them regardless of health. Now, it may not be for what they want, and it's going to be expensive, but it may cover a burial expense. But we do have an option. But it does come times when we just can't get them what they need. The other reason people put off buying life insurance, it can be intimidating. It's a subject they don't know, right? And I'll be honest with you, till I got into it, I didn't know much about life insurance, right? There's a myriad of options. Every broker probably has a life insurance license in some form. They may not be practicing, but they have it. Um, they may not know where to go, who to talk to, right? They get inundated in the mail. Maybe they don't trust calling into a call center to get life insurance, right? So that process can be intimidating. They put it on the back burner, forget about it. All those things that we've probably done or have thought about, right? Or it's inundated with way too many options. As you know today, with every media outlet, everything we're getting bombarded with, everything on our phones to computer to email, you name it. There's a ton of options. Some, I mean, there's a lot of great options out there, tremendous options, right? But it's inundating, right? And you're not quite sure which one to go with. And so it kind of keeps you in just kind of that paralyzed state, so to speak, for lack of a better term. And so ultimately, you don't do anything. And then you sit there and a year goes by or 2 years go by, you still haven't done anything. And so we can help with all of this. Like I had mentioned earlier, I have a wonderful general agent that's partnered with ARC Benefit Solutions, and they do a great job. And we have a multitude of companies. I actually have a second group that we're working with as well to give us some extension of some other carriers and other situations where people may not that they don't qualify, but it's more of what we call a simplified issue. And I'll get into that maybe through another time. But it's not a complete underwriting. They just do a more of a simplified underwriting and do an issue, but it's a little bit more expensive. So we're looking at some of those carriers as well. But we can help solve whatever you got there. And if I can't, we'll definitely reach out to the folks that can and do our best to assist. Um, so why do people, oops, sorry there. All right, let me go back here. I'm sorry, putting off life insurance there. And so we've got that. And then here, right now, we'll just kind of go through a real life example for you. So like I had mentioned earlier, unfortunately, Trina's under the weather, but I thought maybe we could still accomplish what we needed if you guys are okay with that. And I'll just do just kind of a real life example if you're good with that. And so up in the webinar under the materials, so if you guys look where it's got the attachment, if you click there, we actually put a worksheet out there for you guys. And this one is just kind of estimating the amount of life insurance that you may need. Okay, so you can download that, which is a great little piece. And if you guys like, I'll just kind of run through an example. And then at the end of that, I'll kind of show you maybe a policy that would fit that puzzle, so to speak, right? And what I would think would make sense. Now, when I sit down with a client, right? and we kind of go through their situation. Um, Trust me, the first thing I try to mention on a call is that everything they share with me is going to be confidential. It really is. I assure you, it's confidential. I mean, we're getting their personal health information, we're getting their personal information, and that needs to be safely guarded. And we do our best here at ARC Benefit Solutions to do that. And so that should give you reassurance of your information. I'm not out there sharing it. I will never share names on that. I may share an example, but it's never with a person's name that would be identifiable, right? I'm going to get their birth date. I'm going to know if they're a smoker or not. Obviously, I get their height and weight. So I do a little bit of preliminary underwriting just to look at our underwriting guidelines. So when we have multiple carriers, right, and trying to memorize those carriers, I can't do it. I'll be honest with you, but I'll pull up a grid that's got the carriers listed, and we'll look at situations. And then with experience with the general agent, we kind of know if a carrier's a little bit lenient on, say, diabetes, right? If it's AFib or any of these illnesses that are out there, we kind of have, excuse me again, kind of a path in mind that I start to think about before I even get into that needs analysis, right? Because it's one thing to go through their puzzle, right, and get what I think is ultimately going to be the amount of insurance to cover them, right? But ultimately, if I can't insure them, I don't want to waste their time either. So I kind of know in advance kind of where they're sitting a little bit, right? With this worksheet, there's more to this than we're going to show today, and maybe we'll do it in a follow-up webinar as well. And if you guys have questions, feel free to reach out to me, and I can delve into that for you, whether it's a phone call or email for you guys as well. Okay. Um, but with this example, as you can see on that worksheet, if you guys have been able to pull it up, there's an acronym that we use called DIME, just like the coin, okay? And so DIME in this example is for debt and death, okay? And so we're going to figure out their debt picture, right? Credit cards, mortgage, personal loans, car loans, whatever that is, right? So we get a little personal. And again, why we have to keep this confidential, right? And why we want to be a trusted advisor versus someone out there just passing quotes, right? Because we need to kind of know their situation, right? In order for us to do a good job for them, right? And so we're going to get a little bit intimate here, right, on their debt picture. And some people may not feel comfortable with it, and I understand. Trust me, I do. And if you're not, just give me a ballpark number. I don't need to know, where all the debt is or what it is, right? But if you want to just give me a ballpark number, I can work off of that. Okay. And then the death is kind of the pre-planning, right? So it's figuring out, are they going to be cremated? And do they know what the cost of cremation is, right? On that. The other piece is, do they want a traditional burial? And so kind of give you guys a little range of costs right now. A typical cremation with a service is probably $3,000 to $4,000. If you want to go a little bit more, you can get more elaborate, but in reality, you're probably in that range. You could go less. I had a lady, I did a little pre-planning, excuse me, at a funeral home, and they wanted bare bones, and we got it done for 1,600 on a pre-plan for a cremation, and they just wanted to keep their costs down, but it solved what they wanted. A traditional burial right now, it's probably 10 to 12. Do you want to get more elaborate? You can. It's just really what you want to spend towards that funeral expense. And we're going to put that down, right? So the next piece is income replacement. Okay. So I for income. to make this really easy. So with the income piece, um, in this, we're trying to replace that income for probably 3 to 5 years. Okay. If you want to go longer, you can. There was an old rule out there that if you took your income, just multiply it by 10, that was the insurance you needed. Now, that was a simple way to get a quote done without getting invasive with people, but I don't know if it did them the true justice, but it got them some coverage and ultimately it solved their piece. But for an income replacement, 3 to 5 years, right? And so just keep that one in mind there, whatever that income is. Now, M is for your mortgage piece, right? Whatever that amount is. Now, obviously, if you're married, that mortgage piece is still carrying over to that other individual because if you pass, that mortgage is still with them. Now, they could sell the home, right? And not worry about the mortgage. I get that. But the last thing you want to worry about is trying to put a home up for sale as you're going through one of the worst times of your life, right? That's the last thing. Do you want to really disrupt your family? The answer is probably no. This is what they know. They need to be cemented in making sure that life is okay at that terrible time, right? When that unexpected occurred. So a lot of times when we do this debt picture, and if they're married, obviously we're looking at the spouse because we've got to get them covered as well, and that individual, right? So we're looking at, all of their full picture there, right? And then the E on the worksheet is for education, okay? And education on this one could be, outstanding student loan debt, right? That we've carried over, whatever that is. Or it could be for grandkids, right? So a lot of grandparents, that have done very well in their life and have planned properly, right? A lot of times they may get insurance and want to cover the grandkids' colleges or even high school. High schools here in Cincinnati for those private schools have gotten really, really expensive. It's incredible right now. So some of this is being carried over to help with the high school picture as well. Or it's just, and it could obviously be for great grandkids as well, not to keep them out. So whatever that educational picture looks like, we put that number in place. So when we get done going through this, and this is just the first part of the needs analysis, we kind of held off on showing a second piece, and I'll show that later for you guys in another webinar if you guys tune in or if you just call me and I'll share that with you. But we get in then to your investment piece, your 401k, your other investments. Because you may say, John, I've got this X amount of money sitting on the sidelines over here, accounted for this life insurance. So I know you're coming up with a number that I need, but in reality, you might want to cut that piece in half because I'm going to use money in another source to solve the half of that other half of the piece. And so we'll get into that later, but this kind of gives you guys just kind of a starting working piece. And so when we get done, and I look at debt and I look at death and I think about income replacement. And, majority of folks are in that 50 to 60 range, right? Now, obviously, there's people out there doing much better. But just as an example, if we had a couple that were making, let's call it 60, I'll err on the high side, right? Because I want to give them more insurance because really going from X amount and bumping it up a little bit, guys, it's really irrelevant from a budget or a premium standpoint. But in this respect, you're looking at between 150 to 180 at 3 times. And if we go 5 times, it's 250 then to 300,000, right? In that respect. Mortgage, let's just do an average of, why don't we just say 100 grand then, right? Or 150, it doesn't matter. But, as an example here. And then student debt, let's say it's 50,000, right? If it's grandparents, they may want to make that 100 to be able then, if God forbid they passed, they then can put that into an investment account, the beneficiary, probably their kids for the grandkids, right? And then let that money grow. And that is, unfortunately, college is growing at a clip between 6 to 8% a year. It's staggering. Um, but that'll at least get a really, really good start depending on the number of grandkids there. But it just gets you thinking a little bit, right, about insurance and maybe how much you need covered out there, right? So in this example, if I do the high end of, and let's say for the debt and death, I'm going to use a piece of, let's just say 50,000 because cars are so expensive right now too. And that number could definitely be higher. But just as an example, if I use debt and death at 50 and income at 300, so I'm at 350, right? And then let's use the mortgage at 100,000, so I'm at 450 there. And then let's just say the educational piece is $100,000, right? So to solve their piece without going through any investments, I've got $550,000 that I've got to solve, right? That if uh, an individual were to pass, right, unexpectedly, would the beneficiary, would the family be okay? And so for that kind of money, right, of a death benefit, I'm probably going to look at a term situation in that respect, in an easy situation, because I know I can get that kind of coverage. And depending on the term period, whether it's 10, 15, 20 years, and depending on their age and insurability, I know I'm probably going to stay within their budget, right? In that piece. So and even if I have to back that down to make it work, we can. And then maybe later we ladder another insurance piece if life changes, income rises, and then I can ladder another insurance piece on top of it and do an extension of that term and take that out a little bit longer if we need to do. So as you can see, we've got, a lot of different options here, guys. And so um, I hope this was helpful for you. I hope I was able at least to set the foundation of why I think insurance is really important. Maybe, dispel some of those rumors, so to speak, of why people put off life insurance. Because here at Arc Benefit Solutions, you can pick up the phone, you can call us, we can take your information. We've got carriers that can help and we've got some of the best carriers out there. And if the health situation isn't the best, we still have some options for you as well. So I just want to personally say thank you for taking the hour that you did today. I greatly appreciate it. I want to thank my marketing manager here, Jess. I can't thank you enough for assisting today. I want to thank each and every one of you for coming out today as well. And I'll just kind of stop at this point and just see if you guys have any questions at this point that we can go over. I'll be more than happy to answer anything you have there. And then if not, if you guys just want to reach me later, there is my contact information. Feel free to email me and obviously by phone as well. I'll do my best to assist you as well. Okay. All right. Um, any questions? Anything else I can share? All right. Well, again, I just wanted to say thank you and I hope you guys have a great rest of the day. Take care.